Welcome, everyone, to the Gold Talk Show YouTube channel. Thanks for joining us for the deep dive.
Yeah, glad you're here.
So, our goal on these is pretty simple. You sent us the sources, articles, maybe some research notes you've gathered, and we dig through it all.
We basically cut through the noise, try to pull out the really important bits, the insights that actually matter for you.
Think of it as us doing the heavy lifting to get you up to speed on what's really going on.
Exactly. A shortcut to getting informed.
Absolutely. And today, we're diving into something really fundamental, the U.S. dollar. We're looking at, recent developments impacting its role globally.
We've got analysis here touching on the U.S. debt ceiling, the dollar's reserve currency status, and this whole international push around what people are calling de-dollarization.
Right. So our mission today is to really unpack where the dollar stands now, look at the challenges, both, internal stuff like fiscal pressure and external things like geopolitics.
And figure out what all these trends might actually mean looking ahead for global finance.
Okay, so let's get into it. For decades, the dollar's dominance has really stood on a couple of major pillars, right?
That's right. I mean, first off, you absolutely have to talk about America's capital markets. They're incredibly deep, incredibly liquid.
Meaning it's easy to buy and sell vast amounts of U.S. assets like government bonds safely, which is crucial if you're holding reserves.
Precisely. That's number one. And the second pillar, it's less purely economic.
It's more about relationships, isn't it? The alliances.
Yeah, exactly. The huge network of U.S. global security alliances.
Yeah.
The sources point out that countries relying on the U.S. militarily have often held, more dollar reserves than maybe pure economics would suggest.
It's part of that geopolitical alignment.
Mm-hmm. So those two things, the deep markets, the alliances, they've really cemented the dollar as the world's go-to reserve currency for a long, long time.
And it's interesting, despite all the talk about its decline, the dollar's actually been quite strong recently. What's been behind that?
Well, the sources highlight a few key things. One is the Federal Reserve. They moved earlier and, frankly, more aggressively with raising interest rates compared to many others.
Which makes dollar assets more attractive, offers a better return.
Right. And then you had the energy price spikes.
Mm-hmm.
The U.S., being a major energy producer, actually gave it a bit of an edge there, relatively speaking.
Okay.
And, you also can't really ignore the U.S. tech sector. It keeps outperforming, and that feeds this narrative of U.S. exceptionalism. It just keeps pulling capital in.
So this picture of, enduring strength boosted by recent events, but the sources we looked at also flag some real strains appearing, new challenges.
Yeah, this is where it gets pretty interesting. One big challenge is definitely these geopolitical shifts and the perceived risk of sanctions.
Right. The Russia sanctions, especially freezing their central bank assets, that must have felt like a huge wake-up call for many countries.
Oh, absolutely. It really hammered home that holding foreign reserves isn't just about economics anymore. There's a serious geopolitical angle.
It's not just about safety and yield, it's about access and control.
Exactly. And the sources note something interesting. Nearly 3/4 of foreign government holdings of U.S. assets are actually held by countries that have some kind of military tie-up with the U.S.
So for them, that alignment lowers the perceived risk of sanctions. They feel safer holding dollars.
But for countries maybe not so closely aligned or with different political aims, that risk feels much, much higher.
And that fundamentally undermines one of the core reasons for holding dollar reserves. They're supposed to be safe and accessible when you need them.
Precisely. And layering onto this geopolitical tension is the other major challenge. The U.S.'s own financial housekeeping, its fiscal health, its creditworthiness.
Yeah, and we just had some pretty big news on that front, didn't we?
We did. The Moody's downgraded. But maybe first, let's quickly touch on the debt ceiling. It's always part of this discussion.
Right. It was reinstated back on January 2nd, 2025 at, $36.1 trillion. And it's always worth repeating. Raising the ceiling doesn't authorize new spending.
No, it just lets the Treasury pay the bills for commitments Congress and presidents have already made. It's about paying for past decisions.
But the history is kind of wild. It's been raised 90 times since 1959 under both parties.
Yet, look at the debt. It's ballooned from under $2 trillion to over $36 trillion in 40 years. So, as a tool to control debt, not very effective, clearly.
And the consequences, if they don't raise it before the Treasury runs out of those extraordinary measures, the reports paint a grim picture.
Oh, yeah. Potential delays in payments everywhere. Government workers, contractors, Social Security checks, Medicare payments.
And just the threat of default costs real money, right? The GAO pointed to higher borrowing costs back in 2011, costing over $1 billion.
Yeah, $1.3 billion then, and smaller but still significant costs in 2013 to like $38 to $70 million. It adds up.
And beyond the immediate chaos, actually defaulting or even coming close really hammers U.S. creditworthiness. There was a Moody's Analytics report in 2023 suggesting even a short breach could cost millions of jobs.
I think it was 2 million jobs and trillions in household wealth potentially wiped out. Just a massive economic shock.
Which leads us neatly to that Moody's news from May 19th, 2025. They downgraded the U.S. credit rating, dropped it from the top 8 rating down to AA1.
They weren't the first. S&P did it way back in 2011, and Fitch followed in August 2023. So Moody's is now the third major agency to do this.
Okay, so what reasons did Moody's give? Why now?
Well, they pointed specifically to the sustained rise in government debt and, importantly, the interest payments on that debt relative to other major economies.
So the debt itself and the cost of servicing it.
Right. And they also explicitly called out the failure, really, of successive administrations and Congresses to agree on ways to turn things around, to tackle the big deficits and the growing interest bill.
And they don't see current plans making much difference.
Pretty much. Fitch, back in 2023, also mentioned things like an erosion of governance, and specifically the repeated debt limit standoffs as part of their reasoning.
That feels significant. I mean, a credit downgrade basically signals higher risk.
And higher risk usually means higher borrowing costs for the government. We actually saw the 10-year Treasury yield nudge up a bit after the Moody's news.
Which just means even more money goes towards interest payments, squeezing other priorities.
Exactly. So you've got these clear internal fiscal headwinds, the sheer amount of debt, the political gridlock around managing it, the downgrades piling on top of those external geopolitical anxieties we talked about.
Okay, so given all that pressure, internal and external, it kind of makes sense that other countries, especially emerging markets, might be seriously looking around for for alternatives to the dollar.
Yeah, that's the core of this de-dollarization talk, particularly coming from the expanded BRICS group. There's definitely motivation there.
What's driving it from their perspective?
A big piece is macroeconomic frustration. You hear policymakers in BRICS nations worried about how U.S. monetary policy, like rising interest rates, hits their economies.
Making their currencies fall, pushing up inflation.
Right. They talk about this dollar tide that kind of swamps them, causing economic pain and financial instability.
And the reports mention countries like Argentina, Egypt, Ethiopia recently facing really tough times with dollar shortages and high inflation. That makes the frustration very real.
Absolutely. And then, tying back to the geopolitics, there's the risk aversion element, especially post-Russia sanctions.
The feeling that the financial system itself is becoming a tool in geopolitical fights.
Exactly. So holding huge dollar reserves starts to feel less like a safe bet and maybe more like a vulnerability if your political alignment shifts. India's central bank, for instance, has talked explicitly about needing alternatives in what they call a polarized world.
Okay, so the motives are there. Escape the economic volatility tied to U.S. policy and reduce geopolitical risk, but the sources are also really clear that actually moving away from the dollar is incredibly hard. What are the main roadblocks?
Oh, the dollar's role is just so deeply woven into the fabric of global finance. It dominates trade, even between countries that don't use the dollar domestically.
It's just seen as more stable, more widely accepted, used for pricing big commodities like oil, for international loans.
Precisely. It basically acts as the global money medium of exchange, unit of account, store of value for cross-border stuff in a way that, frankly, most local emerging market currencies just can't.
And there's a huge network effect, right? It's involved in almost all foreign exchange trades.
Over 90%. And often, if you want to trade, say, Brazilian reals for Indian rupees, you still have to go via the dollar because a direct market just doesn't really exist or isn't liquid enough. It feeds itself.
So, despite the desire for alternatives, the dollar system is incredibly sticky.
Very sticky.
Now, within this picture, the Chinese renminbi, the RMB, seems to be the currency most actively being pushed as an alternative, especially by BRICS.
Yeah, definitely. Its use in cross-border payments is growing. Especially when a Chinese company is involved on one side of the deal, it's apparently around half of China's own cross-border payments now.
And the Russia sanctions gave it a boost.
For sure. You saw Russian exports invoiced in RMB jump significantly, and it's reportedly being used for trade payments between Russia and some other countries too, not just China.
And China's been building the plumbing for this, right? The infrastructure.
They have. Things like offshore RMB clearing banks, these bilateral swap lines the People's Bank of China has with other central banks to provide RMB liquidity.
And CIPS, the cross-border interbank payment system, that sounds important.
It is. It's designed to make cross-border RMB payments smoother, more efficient. And the sources show it's grown fast, particularly after the Ukraine invasion started. Volume apparently jumped 50% in 2022, another 25% or so in the first part of 2023.
And the key thing is, reports suggest CIPS users might be able to send payment messages without needing SWIFT.
That's the potential game changer, especially for sanctioned entities. Bypassing SWIFT would be huge.
And we're seeing actual examples of adoption in places like Brazil.
Yeah, Brazil authorized an RMB clearing bank. They've got a bank directly participating in CIPS now. They did their first direct trade settle in RMB.
And the RMB actually overtook the euro in Brazil's foreign reserves.
By the end of 2022, yeah. And Argentina is another example. They doubled their currency swap line with China, used RMB credit to help pay back the IMF. Their central bank is even letting local banks open yuan accounts now.
What about other BRICS members? India, for example.
India's central bank is definitely pushing for more international use of the rupee. They've cited China's swap lines as a kind of model. They're pursuing deals for local currency settlement with places like the UAE and Saudi Arabia.
But the growth for currencies like the rupee or the Saudi riyal, the UAE dirham, it's smaller scale compared to the RMB push.
Much smaller, based on these sources. The RMB is clearly the main focus as the dollar alternative within that group.
Okay, so there's activity, there's infrastructure being built, clear motivations, but the sources also stress some pretty major limitations facing these BRICS currencies, including the RMB, in actually challenging the dollar's top spot.
Absolutely. There are significant hurdles.
Like what? Things like the currencies being maybe too volatile or not fully convertible.
Exactly. Convertibility is a big issue for the rupee and even the RMB to some extent. Volatility is another concern. Plus, the financial markets in many BRICS countries just aren't as deep or sophisticated as the U.S. market.
And some face direct issues, like sanctions on the Russian ruble.
Right. And that infrastructure point we mentioned, even with CIPS growing, settling trades directly between, say, South Africa and India is still generally more complex, maybe riskier, than just using the dollar in the middle.
Okay. What about the RMB specifically? What holds it back?
Well, one issue is just the sheer amount of RMB available outside China. It's still tiny compared to the ocean of dollars globally. Economic headwinds in China itself could also make the RMB less attractive.
And the big one seems to be capital controls, right? China still restricts money flowing freely in and out.
That's probably the biggest structural barrier. For the RMB to be a true global reserve currency like the dollar, most analysts argue China would need to significantly open up its capital account, allow much freer movement of money.
Which they might be reluctant to do. And ironically, China itself still needs access to dollars to manage its own currency.
Precisely. And there's a kind of geopolitical catch-22 as well. Countries might want to use the RMB to diversify away from potential U.S. pressure.
But then they might start worrying about becoming too reliant on China's financial influence and the potential for China to use financial tools for leverage down the road.
It's a definite concern. Fear of asset freezes or payment disruptions, just shifting from one potential source of pressure to another.
Okay, so pulling this all together, we have real challenges facing the dollar, fiscal issues, geopolitical shifts, pushing for alternatives. But we also have huge limitations facing those alternatives, plus the dollar's deeply entrenched advantages. So what's the likely outcome here? Is the dollar actually going to be replaced?
You know, the strong consensus from the analysis we reviewed is probably not. Not replaced by a single currency anyway, not anytime soon.
So no RMB takeover tomorrow.
No. What seems much more likely is the emergence of a more fragmented system, a multipolar currency world, perhaps.
So the dollar's dominance, built on those deep markets and alliances, it's definitely being chipped away at by the U.S. fiscal situation and this push for alternatives driven by those frustrations we talked about.
Right. The pressures are real. And some analysis tries to quantify what a bigger shift might look like, especially if the world really does split into geopolitical blocs.
What kind of numbers are we talking?
Well, some estimates suggest if emerging markets and developing economies across Africa, Asia, Latin America, the Middle East really diversified their reserves away from the dollar, maybe following shifts in how they invoice their exports.
Yeah.
You could potentially see hundreds of billions moving out of dollar assets. One estimate mentioned around $800 billion just from a sample of 43 countries.
Wow.
And potentially over $1 trillion, maybe $1.3 to $1.5 trillion if big holders like China and Hong Kong also significantly cut their dollar reserves.
And a shift that big could theoretically push the dollar's share of global reserves below 50%.
It could, yeah. And this is a big, but most analyses frame this kind of large-scale divestment as a risk scenario, a potential future, not necessarily the base case for right now.
It's not guaranteed, or even maybe the most likely immediate path.
Exactly. Remember, as of March 2025, the dollar is still around 60% of global reserves. And that big geopolitically driven shift away faces all those hurdles we discussed. China needing to change capital policies, building entirely new financial plumbing, managing political risks. It's a huge undertaking, even for big players.
So the most probable future isn't replacement, but maybe fragmentation. A slightly less dollar-centric world, but still with the dollar as the main player.
That seems to be the prevailing view, a more fragmented order. And in that kind of world, you might see investors and central banks looking more seriously at diversifying their currency holdings.
Any particular currencies mentioned?
The Japanese yen sometimes comes up as one that might offer some safe haven characteristics in a more uncertain global currency landscape.
Okay, so for you, listening to this, why does all this matter? It might sound quite high level, but these shifts aren't just abstract economics.
Not at all. Changes in reserve currencies, how international payments work, that can eventually filter down and impact things you deal with directly.
Like borrowing costs, right?
Mhm.
Mortgage rates, business loans, they're all linked into this global system.
Absolutely. And the overall stability of the global economy, the value of different assets you might own, including potentially things like gold, it's all interconnected with the status of the world's dominant currency.
It's definitely a complex picture, and it feels like things are moving faster now than they have in a while.
It's a fascinating space to watch, no doubt about it.
It really is. Which leaves us with a final thought for you to chew on. We've talked about two major forces kind of pushing against the dollar's dominance, the internal U.S. fiscal health issues, highlighted by those credit downgrades, and the external geopolitical shifts driving the search for alternatives.
Right, the internal versus the external pressures.
So the question is, which of those two forces, the internal fiscal challenges or the external geopolitical maneuvering, do you think poses the greater long-term threat to the dollar's central role in the world? And why?
Yeah, something to ponder as you watch how all this continues to play out in global finance.
Okay, that wraps up our deep dive today, looking at the US dollar, its challenges, and the future landscape, all based on the sources you shared with us. We really hope unpacking these insights together was useful for you.
Yeah, thanks for tuning in and joining the conversation.
If you found this deep dive valuable, please do give this video a like. Maybe share it with others you think would be interested in these global financial shifts.
And definitely subscribe.
Yes, absolutely. Subscribe to the Gold Talk Show YouTube channel. That way you'll get all our latest news, updates about gold, and more deep dives like this one.
We look forward to seeing you next time.